Welcome to Collin Investing, where we cut through the noise and get straight to the financial insights that matter. I am Collin, and this channel is dedicated to finance and investment. Today, we have a packed agenda, tackling Trump's latest tariff moves and their surprising impact on semiconductor stocks like Nvidia and AMD. We'll then dissect the broader market's reaction, including a look at Tesla's wild ride. After we are switching gears to analyze the major changes in the SCHD ETF, a favorite for dividend investors, and whether it remains a buy after its recent reconstitution. So let's dive right into the big news. President Trump's tariff announcements. What initially sounded like a market-wide earthquake has been clarified, and it's more of a targeted tremor. The scope of the upcoming tariffs is narrower than we first thought. This is particularly interesting for us because it could be a sigh of relief for semiconductor giants like Nvidia and AMD. Remember, those initial headlines? A sweeping 25% industry-wide tariff that had everyone, including myself, worried about a massive 25% jump in the cost of goods, especially for companies relying on overseas manufacturing, like Taiwan synagogues. But that's not the whole story, because tariffs, by their very nature, always increase costs for businesses. It's unavoidable. The question then becomes, what do these businesses do? Well, they have a few choices, none of them ideal. They can raise prices, passing the cost on to consumers, but risk losing sales. They can shift manufacturing, a costly and time-consuming process. Or, they can try to squeeze their suppliers, demanding lower prices. Ultimately, the initial impact was negative. We all knew that the big unknown was, how negative? And the market's response? A resounding, we like that? CMRO stocks in particular took off. Look at the numbers. The SEMH, a key semiconductor ETF, jumped 3%, Nvidia surged 3.5%, and AMD, wow, soared over 6.7%. Investors are clearly breathing a sigh of relief, at least for now. But here is the reality check. We're not out of the woods yet. This initial market jump is a relief rare, plain and simple. We still have a mountain of unanswered questions. Which specific companies will be hit? Which countries are on the target list? Which industries are most vulnerable? How long will these tariffs last, and will there be any exemptions? These are crucial details, and frankly, we are still waiting. One thing is certain. Macroeconomic and geopolitical policy, those factors are going to play a much bigger, more direct role in your stock market returns, whether you like it or not. So, for long-term investors, you see this as a temporary bump in the road, a near-term headwind. Don't let it derail your overall strategy. This relief wasn't confined to just semiconductors. The broader market exploded upwards. We're talking a violent rebound, with the Nasdaq soaring 2.27% and both the S&P 500 and Dow Jones climbing over 1%. But remember the core issue: someone has to pay for these tariffs. The question is, who? And while markets cheer today, fresh PMI data paints a less rosy picture, suggesting an underlying instability in the U.S. economy. We will examine some specific stocks later. The ripple effects weren't limited to just the broader indices. Let's take Tesla, for example. The stock surged an impressive 12%. However, it's not all sunshine and rainbows. They've hit a snag in China, with their full self-driving FSD free trial getting unexpectedly interrupted. And to add another layer of complexity, the FBI is now actively investigating a series of attacks on Tesla facilities. Talk about a mixed bag of news. Now, let's step back for a moment and consider some market history. An interesting, and perhaps slightly scary bit of trivia: the 24th of March, 2025, marks the 20th anniversary of the peak of the internet bubble. Let me give you an idea. From 1995 to that fateful day in 2000, the Nasdaq 100, a tech-heavy index, didn't just rise, it skyrocketed almost 11-fold. Now, I am not saying we're in another 2000, not all. The current rise of AI is a real productivity revolution, unlike many dot-coms back then. Still, you would be wise to exercise extreme caution with those overtyped, money-losing growth stocks. Some things never change. We have briefly examined the general market. Now, let's dive into some specific stock performances, because here is a lot to unpack. Tesla, as we touched on, had significant gains driven by genuine buying pressure. We're seeing a new trading range establish itself for the electric vehicle giant. Amazon also showed strength, with real buying volume pushing it back above that crucial 200-day moving average. Meta's gain, however, was more modest, and I'd still consider its position relatively high. Nvidia had a small gain, but it needs to retake $125 to truly stabilize. AMD, though, that was the star, big gains, huge volume, and it actually broke a minor downtrend. I still believe it's undervalued. Finally, Google, it is stabilized for now, and I maintain it as a solid long-term play. Let's turn our attention now to a cornerstone of many dividend portfolios, the SCHD ETF. For those unfamiliar, South Carolina SCHD isn't just any dividend ETF. It's consistently ranked as a top performer, offering that desirable blend of capital appreciation, a solid yield, and consistent dividend growth. It achieves this by tracking the Dow Jones 100 index, a select group of companies. It has a very specific criteria in beating at least 10 straight years of dividend payments, a substantial minimum market cap, and healthy trading volume. Basically, we're not dealing with speculative small caps here. One important note: SCHD intentionally excludes REITs. So, what actually changed within SCHD? Well, quite a bit. 17 stocks got the boot, including some big names like FARC, BlackRock, and a surprising number of financial institutions. Remember when we talked about a potential financial turnaround? This has resulted in a significant reduction in the financial sector. To balance things out, 20 new companies joined the ranks, featuring familiar faces like Conoco, Phillips, Merck, and Schlumberger. And interestingly, 3 companies were removed, not because they underperformed, but because they were acquired, a sign of a healthy, dynamic market. So, the biggest shifts within SCHD? It's all about energy and financials. Think of it as a seesaw. Energy surged, becoming the dominant sector at 21%, a massive jump. Meanwhile, financials took a major hit, plummeting to just 8%. This reshuffles the entire deck. Previously, we had healthcare, financials, and consumer staples leading the pack. Now it's energy, followed by consumer staples and healthcare, with industrials holding steady and financials now far to the back of the line. And this reshuffling brings us to SCHD top 10 holdings. Notice anything? Energy dominates. Conoco Phillips leads at 4.6%, closely followed by Chevron at 4.4%. We also see familiar names like Verizon and Merck, each around 4%, rounding out the top 10. You'll find a mix, including Bristol, Myers, ABV, Amgen, Coca-Cola, Altria Group, and Lockheed Martin. The weighting reflects the changes and is pretty crucial. Now, the question everyone's asking, what about the dividend? Thankfully, all these changes have a minimal impact on the payout. We're still looking at a yield hovering around 3.8%, and, get this, with heavy hitters like Conoco Phillips now in the top spot, and given their strong dividend growth history, the overall dividend growth rate of SCHD might even get a boost. So, is SCHD still a buy after all this reshuffling? Absolutely. Look, I get the questions, the concerns, but we have to remember, SCHD's algorithm, it's not based on whims, it's tried and true historically. This ETF has delivered, even outperforming the S&P 500 for a solid decade, up until the recent tech boom. It is a great way of balancing our portfolio. In my view, South Carolina SCHD remains the best dividend-focused ETF out there, period. So that's the new look SCHD. I'm keen to hear your take. Hit that like button and subscribe for more deep dives like this. More importantly, jump into the comments below. What are your thoughts on the reshuffled portfolio? What additions are you most excited about? And which removals left you scratching your head, or maybe even a little disappointed? Let's get a discussion going. I read every comment.